Okay, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayana. I am an analyst here at Options Play, and I'm really excited to share with you our thoughts and analysis on the current market. So, before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So, our agenda for today, we'll be starting off with the major indices, the major equity indices. We saw some interesting price action to end the day yesterday, but the major indices are still below their major, or their key levels, I should say. So that is still quite concerning for me, but yeah, we will take a deeper look into that. From there, we'll be looking at fixed income and commodities. On the fixed income side of things, we're looking at some potential reversal, short-term reversals for bonds or yields, as they are kind of at extended levels and they are showing reversal price action. As for commodities, we're going over gold and we're going over oil. Gold is still very choppy. Oil, on the other hand, looking quite bullish still. From there, we'll be taking a look at the sector rotational model. Interesting sector rotation. Again, we're starting to see signs of defensive leadership materialize. And yeah, just to get an overall idea of what sectors are outperforming and underperforming the markets, or what sectors are at least providing the leadership. From there, we have a few subsectors to look at today. And we'll be finishing today's session with some bullish and bearish market observations. So, starting off with the S&P 500. Somewhat ambiguous in terms of price action, in my opinion. Yeah, the key support level has been broken at around 470, but overall, the trend does remain bullish. As you can see here, the overall trend I'm talking about. If we take a look at the daily time frame, there hasn't really been an invalidated change in trend, despite the volatility that we're seeing. We're still seeing price continuing to make higher highs and higher lows. So, in a way, that is encouraging, but at the same time, we are starting to shift our outlook more towards the neutral side, especially when you take a look at, the other things that we'll be showing you for today's session. But in terms of looking at the chart itself on its own, the fact that price has broken below the 470 level, that is quite concerning. And we won't really change to bullish tone here for the S&P 500 unless that 470 level, price breaks above that 470 level. For now, though, this has been a range in the past and may continue to act as a range. We may see a push higher to 470 and a continuation lower. Either way, the next support level will be at around 453. I think that's a fairly strong support level, considering that it was a previous swing high and price already found support at that level on 2 occasions. Also, if you take a look at the moving averages, so the red line is a 21-day exponential moving average. The blue line is a 55-day exponential moving average. And we are seeing price finding support at that level. And we take a look at previous price history here. The reason why we use these 21 and 55-day exponential moving averages, and you can use other similar combinations as well, but take a look at the pattern that we can see here on this chart. We can see whenever price tends to pull back, and if it's on a bullish trend, it tends to pull back to this area between a 21 and 55-day exponential moving average, finds support, and then continues higher on many occasions. Obviously, not on every single occasion, but that for me is always encouraging. I always like looking at that area between the 21 and 55-day exponential average for some bullish price action for a good risk-reward long-term entry. For now, though, I wouldn't consider this to be a long-term bullish entry yet. Macro and fundamentals in play do dictate a more neutral outlook here for the S&P 500, and with the range being between 470 and 453. Again, let's see what happens with inflation numbers tomorrow. Let's see what happens with Powell's testimony today, I believe. So very news-driven at the moment. Taking a look at the NASDAQ 100. Now, this chart is definitely displaying a bit more concerning price action, in my opinion. We can see here a bit of a topping formation, right? We saw a strong rally above 380. Price did consolidate at this level, remained range bound about between 400 and the 380 support level. And from there, on Friday, I should say, we saw an initial breach below that level. And yesterday we saw price closed below that level again. So fairly concerning. And we will get into this in a few slides, but right now, technology is the worst performing sector as investors continue to rotate out of the higher beta, higher risk, higher growth names and into the more defensive sectors, just to protect themselves from what is what is looking like to be a very hawkish 2022. And there's so much uncertainty regarding the timing of interest rate hikes. We know that they are going to increase, but we just don't know when. So again, we are seeing that risk or sentiment. We are seeing investors shy away from the growth names and into the more defensive names, and that is taking a toll on the Nasdaq 100, which does have more exposure to the growth names, which does have more exposure to the technology names as well. So you can see here, price is now below 380. Where would it go now? I mean, if price fails to break back above 380, I would say that's a sign for further weakness here for the Nasdaq 100. Maybe be looking at around a 360 minor area of support that has acted as support in the past, but definitely this range between 350 and 360 would be the next downside target here for the Nasdaq 100, especially with momentum turning negative, a little bit oversold short term, but again, macro just doesn't point to the Nasdaq 100 outperforming the S&P 500. Next, taking a look at small caps. So small caps, once again, testing a major support level at 213 and encouraging price action there, right? We saw a slight gap lower yesterday. Intraday, it did reach 213, rejected that level and closed a little bit higher to end the day. Now, encouraging price action, but for me, small caps are definitely very weak. You can see for the past year also this strong underperformance compared to the major indices, compared to the large cap names, S&P 500 and Nasdaq 100 that were on very strong bullish trends. Small caps were just not participating. We can see here that even though price is finding support at 213, which is constructive, which is encouraging, it doesn't necessarily mean that there's going to be a strong rebound all the way back to 233 and a continuation higher. Again, higher interest rates do put small caps at a significant disadvantage compared to the large cap names that are a bit more safe. So I do expect that underperformance to continue for the next few months. So the RSP equal weighted index. So this is the equal weighted index of the S&P 500, which is a market cap weighted index. In other words, that's one of the downsides to the S&P 500 is that it is a market weighted index and can be guilty of having too much weight in the top 5 holdings or top 10 holdings or so. And that's why we need this RSP 500 equal weighted index to help kind of confirm that price action that we see in the S&P 500. So like when S&P 500 makes a new all-time high, you want the RSP 500 to make a new all-time high with it, because that tells us that it's a broader market all-time high and it's not just the top 5 mega cap Amazons, Facebooks of the world, Apples of the world that are pulling and that are dragging the rest of the names higher. And that would normally indicate narrowing leadership, and that's not something that can be sustained. So the one encouraging thing here that we can see with the RSP 500 is that it is matching similar price action to the S&P 500 by finding support here at the moving averages. As you can see, that between the 21 and 55-day exponential moving average, price has found support there. Now, it did slightly underperform the S&P 500. It didn't end the day in the red, but that's okay. I mean, it didn't end the day in the green, but I think that's okay. I don't think we have to get into that much detail. All we want to know is, how is at a high level, how is the RSP performing against the S&P 500? And so far, the fact that it is finding support by its moving averages, for me, is still encouraging. Maybe not a very bullish sign, but also it does eliminate a very bearish sign as well. So again, a bit of a wait and see game, but I think RSP for now is definitely an important chart to be looking at when trying to analyze the S&P 500. So next we have value versus growth. Again, another very, very, very important chart at the moment. I spoke about the value versus growth chart being going to be a very important chart to look at, I think almost 2 months ago now, especially as we approached all the headwinds that we were seeing for January and February for early 2022, we are starting to see those headwinds materialize. The massive surge in the rally that we saw due to the Q3 earnings, that's kind of dissipated. So we are seeing now those headwinds, such as Omicron, such as higher interest rates, inflation, they are starting to get priced in a bit more heavily here. And we are seeing investors, their risk appetite is definitely shifting off towards more risk-off mentality, especially when you see the fact that value here is breaking out relative to growth. That for me is concerning to an extent with the major indices. The major indices won't rally as much when value is outperforming growth. It'll be very volatile, like we are seeing over the last few days, if not weeks. But still, we could see here, investors are definitely shifting their sentiment to a more risk-off sentiment and are looking for more stable companies to rotate their money into. So, yields, forefront of many headlines in the last few days, and we can see why. 137 basis points a few weeks ago, all the way to 180 basis points just yesterday. Yields did reject that 180 basis point level, kind of bearish price action, if you will, at that level, and it does look quite almost overbought, if you could use that term for yields, which you shouldn't really use overbought for yields, but it does look like the run has kind of happened a bit too fast, too quickly. We are seeing a rejection at 180 basis points. Now, we do overall expect yields to continue higher, but for now, I think there's maybe a bit more room for consolidation or even a short-term reversal for yields before a continuation and above 180 basis points. Again, there's still a lot of unknowns regarding the timing of interest rate hikes. So I don't think it's fair for yields to really break above 180 basis points just yet. But overall, we are in a more hawkish environment and we are seeing a lot of momentum here in yields. We may see a bit more consolidation at current levels or short-term reversal before that continuation higher. So I'll be looking at a lot of the banking names. And if you've taken a look at a lot of the big banks here, we saw such strong bullish price action over the last few days that they are a little bit overbought. And a pullback might actually provide a great long-term bullish opportunity here. So that's what we're looking at. We're looking for that pullback in some of the banking names, and we want longer-term exposure to the financial sector, especially for the first 6 months in 2022. And that leads us to bonds. So we can see the TLT ETF, strong bearish price action. We saw some consolidation after break below 151. Price did decline and hit our 141 targets exactly. There's some bullish price action yesterday. And, from here, I do think this is a pretty strong area of support at 141. But again, we are still, fairly neutral to bearish on bonds, even at current levels. I don't expect a strong bounce. I probably expect a bit more, maybe a bit of a weak bounce or a bit more consolidation here, especially with yields being as strong as rising at the rate that they are. That does tell us that maybe, sure, we might have a short-term retracement, some short-term consolidation, but I don't think a reversal here is really on the cards. But still, it is finding support at around 141. Should that level break, I'd be looking around all the way to around 136, if not 134. This range or this support range will serve for the next downside target should 141 break. So the US dollar, very strong bullish trend in the long term, but a lot of consolidation here in, I would say, almost the last 2 months, really. We are seeing that consolidation after a strong initial rally here in price above the 95.5 key level. But what's pretty interesting is the fact that despite this lack of momentum or this continued decline in momentum, price is still remaining above the 95.5 level. And that is very encouraging, for a bullish case here in the US dollar. We know that with interest rate hikes, that the dollar is going to be in a bit more demand, that there is a long-term bullish case on a fundamental side. And if we take a look at the technicals, the fact that it can maintain above 95.5 despite a lack of momentum, that's a very good technical picture already. Price isn't overbought the same way that it was a few weeks ago. So, we may start to see a bit more traction here for the dollar and a continuation higher above 97 or so. Again, it's a bit of a wait and see game. A lot of this is dependent on the Fed, but again, fundamentals do look good for the dollar, and especially when you compare it to the other basket of currencies that the dollar is compared against, the euro, the yen. These are economies that are not yet ready to really raise interest rates the same way as the US. So I do think there's a bit more of a bullish case here from a fundamental and now from a technical perspective here as well. Gold. So gold, very choppy price action. Yes, we have a bit of a longer term downtrend here, but if we take a look at the last few months, very neutral and very, very choppy. 171 is a key resistance level. That is for certain. We have seen price on multiple occasions react very strongly and reverse lower with a lot of bearish momentum. We're never touching these levels, with the one exception of this false breakout. And overall, our view here is a bit more downside for gold, but we really need dollar to start being that catalyst. We need to see a strength in the dollar, which I'm sure we will see in a few weeks. But once we see that strength in the dollar and with gold moving inversely to the dollar, I do think there is a potential here for further downside. Short-term targets I'll be looking at would be around 165, and maybe a bit to a medium-term target or long-term target would be 161 or so. So next we have crude. Crude, I think we all know, very bullish at the moment. Oil is having a great time with this rally, and we are seeing that swapping over with the moving averages, the 21-day crossing over with the 55-day exponential moving average. So again, from a moving average perspective, there's further upside. But taking a look at the price action itself, we saw this strong bounce from 66.50, a strong rally all the way above its moving averages, above that 75 level, where it did act as resistance in the past. It broke above that, kind of retested that for a couple of days, and is now continuing higher. The last 2 days price has pulled back, but that does look like a typical normal pullback before that continuation higher here. So you can see energy stocks really outperforming the market, which we will get into in a bit. There's a strong outperformance in energy stocks, and this is the reason why. It's because oil is, demand. There's a lot of demand for oil. I think investors probably overestimated the effect that the Omicron threat would have had on oil demand, and price is now essentially correcting and rallying back to where it was before that initial shock from the Omicron threat. So back to 84, 85, that will be our next target in the next couple of weeks or so. So sector rotation. We have 6 sectors in the improving and leading category, 5 in the lagging and weakening category. But if we take a look at what are the sectors that are providing leadership, we have energy on the back of higher oil prices, strong oil demand. We have financials on the back of rising interest rates, or rising yields, I should say. And then we have industrials as well, starting to find good rotation, starting to provide leadership, materials as well. But again, take a look. We have staples, utilities. Okay, not so much healthcare, but utilities and staples. These are defensive sectors. These are sectors that provide defense in, when investors start to get a little bit spooked. These are sectors that they rotate their money into, and we are seeing that rotation back into staples, back into utilities. They were providing leadership in December and have since rotated into the weakening category, but we are already starting to see rotation back into these defensive sectors. And I think that provides a case for, further emphasizes, I should say, the risk-off environment that we're currently in. And, these are the sectors that you should be looking at, the safer names, more stable, lower beta names to provide leadership. Taking a look at some of the weaker sectors, communications and technology, and even now discretionary, losing momentum. These are highly weighted sectors within the major indices, and we can see that they are essentially dragging the indices lower, despite the fact there's so many other sectors that are doing well, that are experiencing positive momentum, positive relative strength. These sectors are such highly weighted that they have the ability to drag the major indices lower here. So taking a look at some sectors of interest here. First, starting off with industrials. So industrials, I like industrials at the moment. We're starting to see rotation into industrials, as we saw in the previous slide. good momentum, but price is now stuck at around 105, 106, this major resistance level. Price did initially break above 106 in the past, came back to break above that, but now we are starting to see that it's finding support at its 55, at its exponential moving averages, which is encouraging. Ideally, you want to see a break and close above 106 for further confirmation higher. But again, the fact that it is able to find support at its exponential moving averages is definitely encouraging. Should there be a further decline here from current levels, I'd be looking at around 100 as a possible support level. Between 100 and 98, this has acted as support in the past. I apologize for my ugly lines there. But yeah, so overall, still a good picture here. We are seeing good momentum in industrials, and I would like to see just a break above resistance for further confirmation here. Financials, as we know, the banks have performed unbelievably well over the last couple of weeks. We can see here financials strong, break above 39, very strong rally, approaching an overbought condition on the short term, which it is starting to pull back. We are starting to see that short-term momentum is showing signs of exhaustion, which is only natural, which is probably a good thing if you want to have a better risk to reward bullish entry or better risk to reward long-term entry. So I'd be looking for a slight pullback here in the financial sector. I don't believe it'll pull back all the way to the 39 level. I do think there's still a lot of juice, a lot of fuel in this rally that we're experiencing. But a short-term pullback does provide a better risk to reward longer-term bullish entry here for a sector that is very strong, and that will be very strong for this year due to the hawkish environment that we are currently in. And staples, so one of the defensive sectors that I was talking about, strong bullish trend for since December, really. We saw staples start providing leadership for the broader equity rally in December, and we're starting to see that outperformance. There was a strong rally all the way to 78, and price is starting to pull back, but on a relative basis, it is still outperforming the S&P 500 now, and we can see that's why there is rotation going into staples. And I do think it provides a good defense against a further market decline, because even if it declines with the further market, it shouldn't be impacted as much. And there is an opportunity here if you consider the fact that this is a pullback. Price is still on a bullish trend. It's a little bit overbought. We are seeing a bit of a decrease in momentum, which is fine. I would be looking for a further pullback back to 76, back to the 21-day exponential moving average area. Price did find support intraday in the past, and from there, possible move higher for staples. Okay, taking a look at some subsectors of interest. First, we have the JETS ETF, which is a US global, basically an airline ETF. I think this ETF provides good broad-based exposure to an industry that, I've said this in the past, very difficult to time. We know that airlines are going to do well in the long term. Now might be the time to be purchasing the shares at a very cheap price and, just buy and hold. But at the same time, we have tried speculating on using option strategies here with airlines in the past with individual names, and it hasn't really worked out that well, because we saw the initial what I would have called almost a false breakout there. Price ran into resistance at 25, came back down, looked like it was breaking above again, but ran into resistance, formed a double top, and actually broke below that 22 level. So, airlines, again, very difficult to time, but we are starting to see that bullish price action with price breaking up above that 22 area, starting to consolidate at this area. And we know that they will rise eventually, they will recover eventually. And I think the fact that, again, investors are pricing in the fact that Omicron wasn't as big of a threat as we initially thought it to be, there might be some upside here, especially with leisure travel recovering at a faster pace. So I'll be looking at those names such as Southwest if you're looking for individual names. But overall, I think having exposure to an airline ETF does provide a better defense for an industry that is very volatile or very, very risky at the moment. Homebuilders, I think I pointed out last week, where price was around that 85 level, that there was further declines ahead, and there was a lot of declines in the last few days. strong bearish momentum. And I will say price did run into support at that 79 level, managed to close above it despite breaching it intraday. While that is somewhat bullish price action, I wouldn't say it's very encouraging for a move higher here. The fact is, at a macro level, as we start to experience a reopening, you will see that consumers will start spending more on services rather than goods, and rather than spending money on improving homes as we did for the pandemic. So this bullish rally that we've seen, I do think there's a very strong case here for a break below that 79 level. And should that break happen, I'll be looking around 72 as the next area of support for the Homebuilders ETF. And the retail ETF, we're pretty bearish on retailers at the moment. Again, it's just due to the fact that due to the economic conditions in play, rising interest rates don't tend to do really, retailers don't tend to do really well with rising interest rates. And we can see here this bit of a topping formation over the last few months, really. We saw, price essentially running into resistance at around that 97, 98 level, near 100. And it kind of just stayed there for a few months. Now we are starting to see that topping formation complete. And especially with this break below that 88 key level. Sorry, it's not a great line there. But I'll draw this zone as that 88 level here, this zone between 88 and around 86 or so. We're starting to see price break below that level. Momentum has turned negative. And I do think there's room for further downside here. And in terms of downside targets, I'd be looking at around 75, 76 or so as possible short to medium term targets here for the retail ETF. So taking a look at some bullish market observations. So I know we are running short on time here, so I will try and be quick. But taking a look at Pfizer. Pfizer is part of the healthcare sector. One of the sectors that is still doing quite well is more of a defensive sector. And we can see here a strong bullish trend, higher highs, higher lows. And we saw a few weeks ago a very strong rally all the way to around 62. A bit of a pullback back to that area between the 21 and 55-day exponential moving average. That has acted as support in the past. If we zoom back, we would actually be able to see that. But you can see here, price does tend to move back to that area before continuing higher. And we are starting to see some bullish price action here at this level. So my expectation is for Pfizer to continue back above its 21-day exponential moving average and continue higher back to around that $60, $61 level or so. So Halliburton, part of the energy sector, and it's at a pretty interesting level. So we are seeing higher highs, or I should say higher lows, essentially with price essentially being squeezed at around this 26 to 26.50 area. Some clues as to some bearish price action at this level, despite the strong momentum that it's currently experiencing. But at the same time, energy, there's a lot of momentum in energy, and I do think it provides the fuel that's needed for a break above that 26.50 level and a continuation higher here for Halliburton, which is it's actually trading near its pre-pandemic drop level. So continuation higher here, but again, you want to see the break above 26.50 first. And next we have General Mills. So General Mills, part of the staples sector. Staples, again, you can see the momentum that it's having here. Strong, very strong rally, a strong pullback as well, all the way back to that area between the 21 and 55-day exponential moving average, and a strong rebound. But multiple rejections at that 69 level. Ideally, you do want to see a break above that level. Despite the fact that there is some bearish price action, the fact is staples are very strong at the moment, and I'll be looking for a break above 69 and for that continuation higher, for confirmation for the continuation higher here for General Mills. Taking a look at our first bearish market observation, we can see Snowflake. So Snowflake, straight away, if we take a look at the 3-day chart, this massive double top at around the 400 level and fairly bearish price action since then. In terms of the daily chart, I'd be looking at, the key levels will be 331 and just this level just below 300, where we can see price broke below the 330 level with strong bearish momentum. It's now at the next support level, just below 300. I wouldn't say there's a lot of strong momentum at this level. Yes, we are seeing a few green candlesticks, but at the same time, momentum is still fairly weak. I do expect a break below this level and a continuation lower here. And again, this is an unprofitable company. This is high beta company. I do think there is a further case for a decline here, given the current market environment that we're in, for a move maybe back to around the 260 level or so. And finally, we have Wheaton Precious Metals, which is not a proxy for gold, but price action is very similar to gold. So we can see here strong bearish downtrend, very similar charts on a higher time frame to gold, and again, very choppy price action over the last few weeks. Again, resistance here at around the 43 level, and 45 would also be another minor area of resistance, which acted as a false breakout a few months ago, I should say. And over here, as you can see, it's very choppy price action at the moment. And overall, our outlook for gold is bearish. So we want to see this break below 38 for confirmation of that and for continuation lower, maybe back to around that 36 area of major support or so. So not a big move expected, but again, it is highly exposed to gold, and our outlook for gold here is bearish. So we do think there is a possibility for a break below the 38 level and a continuation lower. With that, that is all I have for you today. Thank you so much for joining me for today's session, and I hope you have a great trading day ahead. Goodbye.